The mid-1990s were supposed to be Asia's golden years. After decades of rapid growth, countries like Thailand, South Korea, Malaysia, and Indonesia were hailed as the Asian tigers. Their economies were expanding at breakneck speed, their factories churned out goods for the world, and international investors poured billions into their markets. To many, it looked like Asia had cracked the code of modern development. But in 1997, the miracle unraveled almost overnight. What began as a small currency devaluation in Thailand spread like wildfire, setting off one of the most destructive financial crises of the 20th century. Within months, stock markets collapsed, currencies lost half their value, millions were pushed into poverty, and Wall Street itself felt the tremors. The Asian financial crisis was not only an economic meltdown, it was a turning point in how the world understood globalization, risk, and the dangers of hot money. The story begins in Thailand. For years, the Thai baht had been pegged to the US dollar. This peg kept the currency stable, which encouraged foreign investors to pour money into the country. Thailand's banks borrowed heavily in dollars, then lent that money domestically for property development and business expansion. Skyscrapers sprouted in Bangkok, and speculators flipped real estate like it could never lose value. Growth was dazzling, but beneath the surface, the system was fragile. By 1996, warning signs were flashing. Thailand's current account deficit ballooned, meaning it was importing far more than it exported. Real estate prices looked unsustainable, and foreign investors who had once been eager to lend began to worry that Thailand couldn't keep its peg to the dollar. In July 1997, under relentless pressure from speculators, Thailand gave up. The baht was devalued, and the financial system cracked wide open. The devaluation set off a chain reaction across Asia. Investors panicked, pulling money out of neighboring countries they feared might be next. Malaysia's ringgit, Indonesia's rupiah, and South Korea's won all came under attack. These nations, like Thailand, had relied on foreign borrowing to finance rapid growth. When confidence evaporated, so did the money. Stock markets plunged. Companies that had borrowed in dollars suddenly saw their debts explode as their local currencies collapsed. In Indonesia, the rupiah lost more than 80% of its value at one point. Businesses went bankrupt by the thousands. Ordinary citizens watched their savings evaporate. In South Korea, once hailed as a global manufacturing powerhouse, conglomerates known as chaebols faced financial ruin. Wall Street was not spared. Investors who had eagerly funded Asia's boom suddenly faced massive losses. Hedge funds that had bet on Asian currencies being stable were crushed. Emerging markets as an asset class fell out of favor. The Dow Jones Industrial Average dipped sharply as fears of global contagion spread. For a moment, it looked like Asia's problems could trigger a worldwide recession. Governments across the region turned to the International Monetary Fund for help. The IMF swooped in with bailout packages worth tens of billions of dollars, but the money came with strings attached. Countries had to cut government spending, raise interest rates, and restructure their economies. For ordinary people, this meant layoffs, higher prices, and deep recessions. Protests erupted in Jakarta, Kuala Lumpur, and Seoul. In Indonesia, the crisis toppled President Suharto after 3 decades in power. The political fallout was just as significant as the economic collapse. In South Korea, resentment grew over the sight of foreign creditors dictating economic policy. In Malaysia, Prime Minister Mahathir Mohamad blamed foreign speculators, particularly hedge funds led by George Soros, for attacking his currency. While not all of these accusations were fair, they revealed the deep unease many felt about globalization and the power of international capital. The crisis also reshaped how Wall Street thought about risk. Before 1997, emerging markets were seen as a one-way bet, high growth, high returns, with manageable dangers. After the Asian meltdown, investors realized that globalization cut both ways. Capital could flow in quickly, but it could flow out just as fast, leaving destruction behind. Concepts like Contagion, the idea that fear in one market could spread to others regardless of fundamentals, became central to risk management. For Asia itself, the recovery was painful, but ultimately transformative. Countries like South Korea and Thailand undertook deep reforms. They reduced reliance on short-term foreign borrowing, built up foreign exchange reserves, and made their banking systems more resilient. Over time, many of the Asian tigers rebounded and regained their status as dynamic economies. But the memory of 1997 lingered, shaping policy decisions for decades. The crisis also had a lasting effect on the architecture of global finance. Many Asian nations became skeptical of the IMF's harsh prescriptions. In response, they began to accumulate massive currency reserves as a form of self-insurance, leading to the rise of what economists called the global savings glut. These reserves would later play a role in cushioning the region during the 2008 financial crisis. Looking back, the Asian financial crisis offers several timeless lessons. First, rapid growth built on excessive borrowing is dangerous, no matter how bright the future looks. Second, fixed currency pegs can create vulnerability if they don't reflect economic reality. Third, globalization means no economy is truly isolated. Panic can spread across borders with lightning speed. For Wall Street, the crisis was a humbling reminder that the world is interconnected. Traders in New York learned that events in Bangkok or Jakarta could shake portfolios half a world away. Banks that thought they understood the risks of lending to Asia discovered that fear itself can change the rules of the game. And for ordinary people across Asia, the crisis was devastating. Millions fell back into poverty, businesses closed, and political systems were shaken. The optimism of the early 1990s gave way to years of hardship. Yet the resilience of these nations also shone through, as reforms laid the groundwork for future stability. In the end, the Asian financial crisis of 1997 was not just a regional shock, it was a global turning point. It revealed the dangers of unchecked capital flows, the importance of strong institutions, and the need for balance between growth and stability. For Wall Street, it remains a stark reminder. Even the strongest economies can tremble, and even the brightest booms can end in sudden darkness.